Hi, everybody. Welcome back to Ox Talks. Hope you're having a productive day today. Thanks for tuning in. Thanks for watching the show. Appreciate you hitting the thumbs up button, probably the like button. Share the videos with people that you know and love. If you haven't subscribed to the channel, I would really appreciate you hitting that subscribe button. It means a lot to me, and we are growing the community. So I'm going to get into sharing a pretty healthy dose of economic reality with you today, closing out the work week. The stock market came under a ton of pressure today. I show as of close, NASDAQ fell 2.25% or 427 points today. S&P fell 78 points, about a percent and a third, and the Dow Jones fell over 305 points today. This morning, the 10-year yield was marching back pretty darn, flirting pretty close to the 4.5% again. I saw it pulled off of that later in the day, but still, there is a lot of jitters in the market right now with this yield, which we know is going to dictate what the stock market does. And there's a lot of dynamics happening right now. Again, speaking to you as a layperson, please feel free to leave your comments below and your thoughts. But the incoming administration is making some very, very bold picks right now, selections. Obviously, nominations need to be confirmed, but the markets are looking at this now, digesting it. This morning's news about Kennedy for Health and Human Services and how that's going to impact the drug companies and the lobbyists out there, and this interaction that they have. I won't go down that rabbit hole. You all know what I'm talking about. But certain companies fell precipitously today, I believe, on that news. And across the board over the past few days, if you're seeing what I'm seeing, these picks are, potentially really going to stir things up. Now, I'll let you guys weigh in on that. Leave me your comments if you think that's what's needed, or do we want to continue with the status quo? Certain companies, of course, would love to continue with the status quo. And so all I'm saying is this. If you're in the markets, you need to be, I'm sure all of you are paying attention to this. If you're in the markets through your 401k, you really have no control over it, right? You're just praying that the markets go up so that your 401k balances go up, and hopefully you'll have some money there when you retire. But I think it's interesting to pay attention to, and please do, what's happening with these picks, all right? And the articles I'll share to you, again, is good news for the economy, as one of the articles. Is it bad news for the markets now? Because if you caught Jerome Powell's comments yesterday, he came out and said something to the extent, we don't really need to be in a rush to be cutting interest rates or lowering interest rates. That was an about face. I mean, when you say we don't need to be in a rush, but over the last two Fed meetings, you have now cut the Fed funds rate by 75 basis points, 50 basis points, and then recently 25 basis points, with the markets until today expecting another 25 basis point cut at the December meeting. And those bets are starting to unwind a bit, I think, and a lot of it has to do, I think, with these incoming administration selections. So let me jump into a couple articles I saw. First, from Watcher Guru. No surprise, U.S. economy household debt reaches $17.9 trillion, okay? Yeah, yesterday, Powell's out saying that the economy and the consumers are really, really doing very, very well. It says the various forms of debt incurred by the American household are a serious cause of worry to the U.S. economy. The overall household debt in the U.S. has reached $17.9 trillion, as is only ballooning every month in 2024. This puts the U.S. economy, it says, at risk, and it's a ticking time bomb that could explode as failures in repayment grow. The New York Fed reported that student loans, credit card swipes, and car loans remain the biggest culprits. However, these three forms of loans are not even part of the housing debt, which is bigger than those three combined. Student loans have surged $1.61 trillion Credit card debt grew at 1.17 trillion, and car loans, it says, shot up 1.64 trillion dollars. Again, folks, the fact that people are taking out debt and running up credit cards, in my mind, again, I don't know what I'm missing here. That does not equal a strong consumer. What it equals is a consumer that might have additional credit available on their credit lines, on their credit cards, or is able to go and convince some, car financing company that they should be given a $100,000 car loan for a new BMW that they really can't afford. Says the U.S. national debt touched $36 trillion in November of 2024. That falls to it falls to 106,000 per person residing in the United States. Says the U.S. economy, not just household, but all forms of debt are rising. The household debt of 17.9 trillion is equivalent to at least 64% of Americans' gross domestic product. However, economics, listen to this guy. This is the kind of stuff that, it gets me fired up. However, economics research advisor Dong-Hoon Lee said that the growing household debt in the U.S. is not worrisome at all. He explained that the U.S. economy will sail through as income has seen a steady increase since the pandemic. Lee states that the increase in income would fill the gap in the household debt, making repayments stronger. The income growth will outpace the household debt burden, leading to the easing of the U.S. economy, according to this guy, Lee. The advisor indicated that a dip in delinquencies will be recorded in the coming years. So what he's saying is household income is going to exceed the pace at which people are taking on household debt, and that the delinquency rate is going to fall. Okay, let me ask you this. This is a question. It's rhetorical, but feel free to give me your thoughts. If this guy Lee is correct, and the household income really is either keeping pace or exceeding the pace that household debt is being taken on, then why is the household debt skyrocketing? If people really could afford to go out and pay cash for something, why would they go and borrow the money and pay interest at 20, 25, 30%? It's not happening. It's a fallacy. It's a joke. This guy, whoever this guy is, it's not making any sense. Is your household income keeping going up? Is it skyrocketing? Is it exceeding the obligations that you have each and every month? Love to hear your thoughts. Next one out of the Market Watch today. And this says, good news for the economy is looking like bad news for stocks. And this is going to circle back to the Fed's comments from yesterday and the market expectations, which I believe, again, as just an observer, not an expert, is the reason why you saw a sell-off of the market today. And you might see a continued sell-off as the rest of this year unfolds. Says the growth scares that helped spark deep but short-lived losses for stocks in early August and again in early September are looking like distant memories. Instead, investors appear to be preoccupied with a new concern, the notion that the economy might be running too hot for their liking, right? The strong consumer again. While recent monthly unemployment data released by the Department of Labor have cemented the notion that the job market is indeed cooling, this hasn't stopped consumers from continuing to spend. As a result, the economy remains in robust shape, albeit, I'm adding this, built on a house of debt, right? Helping to push Treasury yields higher. Higher borrowing costs are an anathema to stock valuations because they increase the cost of carrying debt for corporations, making it more difficult for them to finance capital investments and, perhaps more important, their beloved share buybacks. And I added the word beloved, right? A little bit of sarcasm there. Economic data released this week appear to have reinforced this notion, with Friday's retail sales data showing that consumers continue to spend over the last couple of months. Asked whether this means that good news for the economy is becoming bad news for stocks, George Cipollini, a portfolio manager at Penn Mutual Asset Management, responded in the affirmative. He says a key point that Powell made yesterday was how exceptionally strong the U.S. economy has been and the persistent strength from a consumer standpoint is a major reason why. So the market seems to want the Fed to continue along its rate cutting path, but it doesn't look like recent economic recordings will allow for it. He said in response to questions emailed by Market Watch, right? So the key is the markets want lower rates, okay? Lower borrowing costs, lower debt servicing costs, okay? But that may not be coming, folks. And what's that going to do is they're going to continue to send the stock market into a hissy fit. For months following the start of the bull market in October of 2022, stocks seemed to climb no matter what the economic data showed, as long as the inflation rate continued to grind lower. That appeared to shift over the summer when investors started to worry about whether the Fed might have kept interest rates too high for too long, raising the threat of a recession that could eat into corporate earnings. But that shifted now. It says now the concern that the Fed may have cut its policy rate target too quickly are helping to fuel a rise in Treasury yields, right? We discussed that. It's going to obviously go back to 4.5% pretty quickly and maybe to 5%. With the 10-year note flirting with 4.5% on Friday for the first time in 6 months, according to FactSet data. Cipollini says rising yields are currently the biggest threat to the stock market rally. If we see a resurgence of inflation that drives the 10-year yield back to 5%, he says, I would be incredibly surprised if the stock market takes that well, given current valuations, right, which are in the stratosphere. And I think I discussed that on yesterday's video about the bad news, or day before yesterday, about the bad news being the resurgence of inflationary pressures. Fundstrat's Tom Lee pointed to market-based measures of inflation expectations, which have risen substantially since July. This has added to the upward pressure on yields and to the pain for stocks this week, he says. It says Fed funds futures Friday exhibited a sharp drop in the probability of a cut in December. So expectations hovered around 55% in recent trading, according to CME Group data. That's down from 70% on Thursday. So yesterday, the expectations or the expectations of a 25 basis point cut in December were 70%. As of today, they're 55%. So as those expectations drop for a further rate cut in December, the stock market might drop along with it. All right. Again, I'll leave it there today. Not great news. A lot of dynamics in play. Hope you guys are hedging your bets, whether it's in the market, whatever market you're in, stock market, crypto market, metals market. You can't have all your eggs in one basket. Keep some cash on the side. Just be prudent. Have a great weekend, rest of your day today. Get that workout in. Stay active. Let's get healthier. I should be able to speak with all of you in the next couple of days. All right. Talk to you soon. Bye.